Hello. Today we're going to look at what you can do if you're having difficulties paying your loans. Before you take out a loan, the bank will usually carefully consider whether you will be able to repay your debt. They look at a lot of things, but this is no guarantee that everything will go smoothly. Especially not for 30 years. All you can see here is that they'll probably have their money back. This is not against the banks, for two reasons. For one thing, they are putting depositors' money at risk, and you wouldn't take kindly to the burden of all that lending being paid for by you. Secondly, you are a grown man and they assume you know what you are doing. Regardless, all banks, including even the central bank with no direct customer relationship, consider it important to make repayments as smooth as possible. Because then fewer people get into trouble. Ideally, you should have thought things through before taking out a loan and made sure that you have an emergency reserve that allows you to get back into financial balance. Regardless, even with the most careful consideration, life can still bring changes. And it's not necessarily your own fault. Payment difficulties can be caused by many things. For example, a loss of income due to illness, even if you are not ill but have a child to care for at home. But it could also be the loss of a loved one or just the loss of a job. The latter is also in play if you were the perfect employee but the company had to downsize, or maybe the company is no longer exist. You may also find that you simply can't afford something because of a sudden need for a large expenditure. Last but not least, a rise in your repayments due to an interest rate rise could lead to this. Then the old one was fine, but the new one has some problem. When such a situation arises, there are several possible solutions. Let's look at what you can do yourself. If you are in payment difficulty for whatever reason, be very proactive. You may then be able to get out of the hole on your own, or if not, you may score a good point in the eyes of the financial institution that is granting the loan. The bank is operating within a regulated framework, but if you indicate that there is a problem, or rather that there will be a problem, the bank can draw on many more options and is often more cooperative in human terms than if it were to take action ex officio. But if you just hide, not only will you not get away with it, but you could end up in an even worse situation. There are steps you should definitely review. The bank will ask you about these, and even you may not have to go to the bank. The first and most important is the budget. I mean your own family budget. See how much money is missing from the pot. Can you save it on other items? In addition, look at the possibility of increasing your income. Is there any way you can earn extra income? This could be a second job, a request for a pay rise at work, or even state or government assistance. If that doesn't help, then the question is whether there is family assistance. Is there a family member who can give you a helping hand in case of payment difficulties, even temporarily? This doesn't mean that they have to pay your mortgage for you, it is often enough to take the burden off your shoulders in other areas. I mentioned at the beginning that it's a good idea to think things through before you start, so prepayment is a viable option. The question is there a source of money that you can use to reduce your outstanding debt? This could be savings you have set aside for yourself or even a larger amount from any other source. If you repay early, your outstanding debt will be reduced. If this is not enough, you can ask the bank for help. Some options involve modifying your existing loan and others involve keeping your old loan. Let's look first at the options that involve modifying your existing loan that has become problematic. The first of these is a debt settlement loan. A debt settlement loan is a viable option even if you are not struggling to make payments. If you have several loans, especially high-interest loans, and you foresee that you will have difficulties in repaying them in the near future, a debt settlement loan is recommended. This is a mortgage loan that the bank gives you to settle and consolidate your other debts. The advantage of this is that, because it is backed by real estate collateral, the APR of the loan is much lower than, for example, an APR of a credit card. Many people are put off by mortgages, saying that even though they are cheaper, if you get stuck paying them off, the bank will take your house. There's a bad news. If you default on your credit card or other non-mortgage loan, the bank will get its money by foreclosing on the assets in your name. If you have no other high-value assets other than your property, it ends up the same either way, but using a debt settlement loan is a way to avoid this. Another advantage is that it is no longer a line of credit, meaning it is no longer renewed. It is repaid by annuity, so here you cannot reuse the repaid capital. From your point of view, this is advantageous because your debt is reduced every month. The next option is the loan redemption. It is similar to the previous one, but here you can also exchange only one loan for a loan with a more favorable condition. It is possible that there will not be a big difference between the monthly installments of the two loans, but in some cases this little one can be crucial. You are more likely to overpay on a loan with a disadvantageous condition. The possibility of interest rate rises has been around since the days when all reference interest rates were at historic lows. So if you have a loan with a short interest period, it is now both risky and disadvantageous for you. The next option is to sell your property. Payment difficulties often occur with long-term mortgages. In this case, when you have played all your cards, you can choose to sell the mortgaged property yourself. You pay off the outstanding debt and move to a more sustainable property. The advantage of this solution over a bailiff is that you agree the purchase price with the buyer yourself. You can then sell the house for around the normal market price, as opposed to the bank doing the same for a fraction of that. For properties forced sale by the bank, the starting point for the purchase price is the total amount you owe the bank plus the cost of foreclosure. This is certainly less than you can get for it. Of course, you also have the option of keeping your existing loan. Let's look at these two. Let me say up front that these can only work for normal, market loans. For a state-regulated subsidized loan, you should always ask the bank individually for its opinion. And it probably goes without saying that these are not free options, as they involve a modification of the contract. Unless the bank decides otherwise, the contract modification fee is based on the outstanding debt. If you have difficulties, one of your options is to restructure your existing loan. If you have taken out a combined loan, say in combination with Housing Savings Bank to buy a home, you pay the capital to the Housing Savings Fund under your contract and the interest on the loan to the bank. In case of payment difficulties, you can ask for this to be converted into a conventional home loan and even have the term extended at the same time. Then you may lose out on many of the benefits later on, but at least you'll be in balance. The other option is to extend the term. In case of payment difficulties, you can ask the lending bank in writing to extend the term. They will then spread the same amount of credit over a longer period, so your regular monthly repayments will be reduced. Importantly, your payment obligation is not reduced proportionally. So, if you have twice the term, it will not be half, as you will then pay slightly more interest to the bank because you are using their money for longer. The next viable option is to reduce the interest rate. Of course, it is not zero interest because it costs the bank money to lend you money. We can talk about reducing the interest rate surcharge here. Not all banks will approve this, but there are still cases where the interest rate already included in the contract is reduced for a certain period of time to avoid having to cancel the loan. If for some reason the interest rate reduction does not work, you can ask for discounted repayment period. This period lasts up to 6 to 12 months, depending on the bank and the type of loan. You will then pay the bank a lower repayment than before. It is important to note that this amount must cover the interest on your loan. It is only a deferral of part or all of the repayment of the principal. Obviously, if you are in big trouble, you can ask for a deferment of the repayment of the principal from the start. It's similar to the grace period, and you can ask for this option straight away. Last but not least, debt capitalization is also a workable idea. You can ask the bank to capitalize the principal and interest that has fallen due. This means that your outstanding debt to the bank will increase by this amount, but you will not be late in payments. This is an obvious option for you if you have already resolved your payment difficulties and are back on your feet, but not yet in a position to pay your arrears on time. This step will increase your debt, but you can avoid getting into another difficulty straight away. Of course, after capitalization, your monthly payment obligation will be recalculated, and the newly approved capital will be spread over the term of the loan, thus increasing your principal and interest repayments. In conclusion, there are countless and one more solutions to late payments. Believe me, it is not good for the bank to foreclose either, as it is neither a real estate salesman nor a car dealer, so it is also important for it to make sure that the loan runs as smoothly as possible. The easiest way to do this is to think carefully before you take out a loan about whether you really need a loan and if so, what amount you can afford. If despite all this, you still have problems repaying the loan, be very proactive and report everything to the bank in time. This will help them to assess your application more positively, as they will see your willingness to cooperate, and they are also bound by deadlines. If they exceed a certain number of days in arrears, they will have to hand it over for enforcement, which will put you in a worse position.